Hello everyone, and welcome to Alternative Design's presentation of the August product launch. I'm Tim Harding, Chief Marketing Officer at Alternative Design, and welcome to this week's webinar. I've got some good-looking products this month. I think there's some real opportunities waiting for you out there. Before we jump into the products, though, I wanted to just do a quick review on what we're really up against. You know, market-linked CDs are really designed to outperform traditional CDs by 3 to 4% on a consistent basis, and historically they have done that. But I want you to look at what you're competing for here in the terms of CD money. According to Bankrate.com, the average yield nationwide on a one-year CD is less than a quarter of 1%, 0.24%. And the average yield on a 5-year CD right now isn't much better. It's a whopping 0.79%. So when you take into account that the minimum guarantees on the market-linked CDs exceed what's available out there in the traditional CD marketplace, plus with the upside potential, you know, you've got a fairly easy sale there when you're trying to capture that CD money that's lying around. And, you know, just as a reminder, people aren't happy about the low returns they're getting. And those 4 questions that we preach all along: have you ever invested in CDs? You know, what did you like best about them? What did you like least about them? If I could show you an FDIC insured product that has the potential for a much more reasonable rate of return, would you be interested? You're going to get a lot of yeses. So sometimes it's good just to go back to basics and talk about the fundamentals. And even though it's a very, very simple approach, the 4 questions do start the conversation, and you will pick up sales as a result of that, especially when you get familiar with the products that we're putting on our platform going forward. By the way, jumbo CDs, which have a little bit higher rates, take a minimum deposit of $100,000. The average one-year jumbo CD is only paying 0.26%, and the average 5-year jumbo is only paying 0.83%. So clearly, there's a huge, huge opportunity here for you to capture your share of that CD money that's sitting around, not even keeping up with the core rate of inflation in the United States. We've got 4 products on our platform for the month of August. 2 from Bank of the West, which you're quite familiar with, 1 from Barclays, and 1 from Goldman Sachs. And we think this covers the bases pretty well. In terms of compensation, Bank of the West pays a little bit better. So both of the 7-year Bank of the West products offer a commission or a referral fee this month of 2.5%. So 2.5 on both Bank of the West products. The other 2, Barclays and Goldman Sachs, each offer a 2% referral fee. So reasonable compensation for, you know, picking up CD money that you likely would have left on the table before. We've got the returning commodities income advantage product from Bank of the West, and the corresponding equity income advantage is back by popular demand. So those are the 2 Bank of the West products. The Barclays product is a more traditional 7-year product with a basket of 10 stocks, and the Goldman Sachs, of course, is my all-time favorite, at least at this point. That is the 7-year momentum builder. So let's take a quick look at them in a review. Not a lot of changes this month, so probably will be a shorter webinar than normal, but let's do a quick review. The Bank of the West Commodities Income Advantage product, 7 years, pays an annual minimum of 1% or a maximum of 7.25%. Nothing in between. It's linked to a basket of 5 commodities. I think they've been consistent with these 5 commodities for 2 or 3 months now at least. It's linked to cocoa, coffee, corn, lead, and natural gas. And of course, the way this product works is it's an either-or product. There's nothing in between. If one or more of those commodities are negative, the client is going to receive the minimum guarantee of 1% for that year. If all 5 of those commodities are equal to or greater than their initial share price on the anniversary date, in other words, if they're all in positive territory, even if it's only a little bit, the client is going to receive the maximum payout of 7.25%. So, I mean, you can do the math on this. It doesn't take much to really have a nice return over the course of 7 years here. If you only hit that 7.25 a couple of times, you're already way ahead of the game. And if you hit it, 3 out of the 7 or 4 out of the 7, now you're talking a superior return to just about any other safe vehicle out there. So a very attractive product. It's the only product we have this month that is linked exclusively to commodities. Of course, the Momentum Builder has some commodity play in it, but the Bank of the West Income Advantage product, the either-or product, is linked exclusively to those 5 commodities that I listed a little bit earlier. So it's the only direct link commodity product that we have for the month. So let's move on then to the equity-linked CDs, and they're going to look familiar to you as well. We have the Income Advantage equity counterpart to the commodities product. Again, the Bank of the West product, 7-year, but instead of being linked to a basket of 5 commodities, it's going to be linked to a basket of 5 stocks. It also has a minimum guaranteed rate of 1%. And a maximum, a little bit less than the commodities upside, but not much, a maximum of 7%. It's linked to some familiar sounding stocks. The traders at BNP Paribas seem to like these. They keep going to them. Darden Restaurants is in there again, Duke Energy again, GlaxoSmithKline, which is a pharmaceutical company. Seems like there's always a pharmaceutical in there somewhere. PPL Corp, which has been in before, and Verizon, which you've also seen before. And of course, this is the standard either-or product. If all of those stocks, those 5 stocks, are equal to or greater than their initial share price, the client gets the 7% payout in that year. If one or more of them is negative from the initial share price, the client will instead receive the minimum of 1%. So worst case scenario, they're going to outperform a 5-year jumbo CD. Worst case. Best case, they hit 2 or 3 home runs or 4, 5 home runs in there and end up getting an average annualized return that's very, very attractive. So the 2 Bank of the West products both pay a 2.5% referral fee. Both of them are the Income Advantage either-or calculation methodology, one based on 5 individual stocks, one based on 5 individual commodities. So we like this product. It's very, very easy to explain and to a client or a prospect, and we think the upside potential is very, very good given history. The Barclays product is a more traditional equity-linked product. It's a 7-year equity-linked product with a 1.40 minimum annual guarantee. And so worst case scenario, your clients are going to be getting roughly twice what they could get in a 1-year CD, guaranteed. Guaranteed. This product has a 5% auto cap and a minus 10% return floor. So very, very attractive product. It's going to pay 1.4% worst case scenario, and in the best case scenario, up to 5% on an annualized basis. This product is linked to 10 individual stocks. This basket of stocks includes some big names that you and your clients are going to recognize right away. Apple is in there, American Express, ConocoPhillips, Ford, PPL Corporation again, AbbVie, which is another pharmaceutical company, Bristol Myers Squibb, Cisco, Microsoft is in there, Williams Companies is in there as well. So this product is not either or. It's basically an average of the performance of these 10 stocks with the auto cap feature added in on top. So the way the auto cap works, just as a quick refresher, is on the calculation date, or what we would normally call the anniversary date, we compare the initial share price when the offering closed to the current share price for each individual stock. If the share price difference is negative, then we're going to credit each of those individual stocks with the negative, but not lower than the floor of minus 10 in this product. In other words, if one of these stocks has a minus 15 performance for the year, it's only going to count as a minus 10% for purposes of averaging the performance of the 10 stocks. So that floor is very, very important in determining the actual interest paid. So if the share price difference is negative, we credit each component with the negative, but not any lower than that minus 10% floor. If the share price difference is not negative, meaning if it's equal to or greater than its initial share price, each of those components are automatically credited with the cap, in this case 5%. So if the stock is not negative, it's going to be credited with the 5% cap. And then they're going to add all of those up, the negatives and the caps, divided by the number of stocks in the basket, which in this case is 10, and that would be the interest payment for that year. So you're going to get an average of the performance of the 10 stocks subject to the cap of 5%, the auto cap feature, and a minus 10% floor. So that's the traditional market link CD. Those have been around for some time. And here's my favorite of all time so far. In the multi-asset category, the all-weather CD from Goldman Sachs, referred to as the Momentum Builder. It is also a 7-year maturity, but the interest is calculated on what I refer to as an annualized point-to-point methodology, which I'll walk you through in just a moment. The big thing about it is that it's multi-asset linked, has a 100% participation rate, and no cap. Folks, if you're not familiar with this particular product, you need to get to know it right away, because this is a mutual fund killer. I mean, this is a managed money killer. This CD will stand up to just about any strategy that your clients or prospects have been enticed by. This product pays a minimum guaranteed annual interest rate of 1%. So once again, it's going to outperform traditional CDs, even if it doesn't perform. Even if the returns are negative, client is going to receive a 1% minimum annual interest payment. Now, this product is built on math. There is no money manager flying by the seat of his pants making decisions that affect the returns. This is a completely rules-based methodology, meaning it's all math and logarithms. And it's built on a momentum-based theory and modern portfolio theory. And you combine those two together and you get a very, very effective strategy in asset allocation. It rebalances each and every month, and it's managed for volatility on a daily basis, which gives it a nice, steady return, not a lot of big swings up or down, which is important to a lot of clients. The product is linked to over 7 different asset classes. So if somebody thinks the stock market is not going to do well going forward, that's fine. This isn't tied just to the stock market. If somebody thinks the commodities market is going to tank, that's fine. This isn't tied just to commodities. If somebody thinks the U.S. economy is going to be lousy, the European economy is good. Look, it's all in here. Take a close look at the asset classes in this particular product. You've, of course, got the money market in there so that the CD can go to a cash position if necessary. You've got developed market stocks. So, of course, you've got a link to the S&P 500, but also to Japanese and European markets. You've got bonds. Of course, you would have a classic asset class mix of stocks and bonds. You've got U.S. bonds, treasuries, high-grade investment-grade corporate bonds, and high-yield corporate bonds. So you've got a good bond mix there, but also you get exposure to emerging markets, economies that are starting to grow at a much more rapid rate than developed economies do. You've got exposure to all types of markets there, and you've got alternative investments packaged inside this. You've got real estate, and you've got the senior loan portfolio, which is basically corporate debt, and of course you've got exposure to commodities through the power shares and direct exposure to gold. And this is an absolutely fabulous asset allocation strategy. all packaged into one, all driven by sound math. And because it's all done by math, it can be back tested. And you can show your clients and prospects historical performance on this product. It's not true of many of the CDs that we bring on our platform, but because this is mathematically based, it's a rules-based approach, we can back test, and the banks have allowed that, and in fact promote it. You can see the red line here in the center as compared to other asset classes. This mixture smooths out the volatility and produces, for the most part, a steady growth to the account. Very, very attractive. And I've put these returns up before, and I just want to keep putting them up there because these are absolutely outstanding returns. If you take a look at this, and even if you disregard 2003 down at the bottom where there was a 22.47% return, you're still coming out with a return here in the neighborhood of 6% on an annualized basis for an FDIC-insured product that has principal protected and a minimum guarantee of 1%. So you can look here and you can see that the index that this is linked to only had one negative year between 2003 and 2014. And that one negative year was in 2008, and we all know what was going on there. Look how this fund performed in 2008, a minus 1.5. Folks, the stock market lost, the S&P lost what, 50% from its peak to its bottom? This is an absolutely marvelous product. It's got a great story. It's got a lot of sizzle, and the math is real. You can back test it and see what's going on here. It uses a little bit different crediting methodology than you might be familiar with. I refer to it as annualized point-to-point. The purpose of the annualized point-to-point is so that it pays interest each and every year. This avoids the phantom income tax problem that some of these products may have. There's no question about this one. It doesn't have an issue with phantom income because it uses this methodology, the annualized point-to-point. Basically, it works very simply. It sounds a little odd at first if you've never heard it before, but it's a very, very simple approach. It goes point-to-point on an annual basis divided by the number of years. So every year, you start with the initial share price, you look at where the index is at the end of that year, you divide the difference by the number of years, and that's paid annually. So here's an example from the disclosure documents on how this would work. You can see on the far left-hand side where it says coupon determination date, you've got the first, second, third, fourth, fifth, sixth, and seventh anniversaries. So on the first coupon determination date, it says that the cumulative index return, the third column, was 4%. Well, it's the end of the first year, so we're going to divide by the number of years. That's 1. So 4% divided by 1 is 4%. The interest payment, or coupon for that year, is 4%. Second year, you can see that the cumulative index return is now 8%. So we're going to take that cumulative return and divide it by the number of years, which in this case is 2 now. So we've got 8% divided by 2 is 4%. That's the coupon or interest paid for that year, and so forth and so on. You can see down in the fifth year, the cumulative return is 2%. So the index in this hypothetical has fallen, highly unlikely, I think, given its nature. But if it were to fall, it's in the fifth year, the fifth calculation period. So that 2% would be divided by 5. That's a return of 0.40%, but it has a minimum of 1% guaranteed. So the client in this instance would receive the 1% instead of the 0.40. So really a fairly simple mathematical equation. Once you break it down, nothing very startling about it, and it makes sense because it does eliminate entirely the potential issue of phantom income. Cutoff dates this month. The Bank of the West product, the commodities linked product, the cutoff date is Friday, August the 22nd. You got the weekend for the rest of them. The other three close off Monday morning Pacific time, 10 a.m. Pacific time, 1 o'clock Eastern time, Monday, August the 25th. So those are your close-off dates. That's the offering period. I think we've got 4 really good-looking products for the month of August, especially that Goldman Sachs Momentum Builder product. But the others, I think your clients will really like as well. So a lot to do this month. With that, I'll pause here and see if there are any questions. As always, if you have a question, please go ahead and type it into the chat box on your control panel, and I will respond to as many of those as show up. So if you have questions on any of the products or any of the calculation methodologies, please go ahead and type it in, and we'll be happy to respond to those. Let's see what we have here. Okay, Anthony asks, is there any type of seminar presentation that we could make available to you that you could use with consumers, or is there any planning for such a thing in the future? The answer is we don't have anything right now, but we have been thinking about it. Those of you who've been with us a while remember we did some consumer-oriented webinar broadcasts. Our summer solstice program was one of them, as was our March Madness program a year ago. So there are things that we can put together for use with the public. Don't have anything off the shelf right now, Anthony, but we are working that direction. Working on that direction. Fred asks, can the sheet be faxed or emailed to us? I'm assuming you're referring to the product grid, Fred. And if that's what you're referring to, you will find it under products in the agent portal on our website, and you can download it there. If you've got a problem, give your business consultant a call, and we'll make sure that you can get it. Question from Gil on the liquidity of the Goldman Sachs product. It is like every other market-linked CD. You can sell it back to the bank or redeem it at whatever the current market value is. So it is liquid, but just like a U.S. government bond, it may be worth less or it may be worth more than the initial purchase price. So subject to market fluctuations, it is liquid at any time, with the knowledge that there's the possibility it would be less than the original principal amount if not held to maturity. And Deborah asks, can you explain what happens when someone withdraws from a CD prematurely? And I pretty much just did, Deborah. It can be sold back to the bank at the current market value, which might be less or might be more than the original principal amount. We find that usually in the first 3 years or so, it's likely to be a negative. It's likely that it will have to be sold back at less than the original principal amount. The client, of course, keeps any interest that has already been paid, so that's a mitigating factor. And the other thing to keep in mind is that although our minimum account size is $25,000, the CDs are actually issued in $1,000 denominations, which means that if your client puts $25,000 into CDs, they don't have a single $25,000 CD. They have, in fact, 25 $1,000 CDs, and each of those could be liquidated independently of the others. So in essence, you would have the same effect as what we would call in the insurance industry a partial withdrawal. So you might have 25,000 in there and liquidate 5 of the CDs to get the market value of a $5,000 commitment. Okay, another question from Lynn. How do they calculate the surrender value before maturity or in the case of a premature death? Okay, great question, Lynn. The calculation is really based on the value of the underlying assets of the CD. So it would be the value of the U.S. government bonds that are held to guarantee a return of principal and the value of the options that the bank has purchased to produce their return. So it's really based on the market value of those underlying assets. That's going to determine what the client gets back for the CD. In the case of death, all of the products that we put on our platform have what's technically referred to as a death put. or a survivor benefit. And what it says is that if the original depositor passes away prior to maturity, the beneficiaries may either hold on to the CD until maturity and continue to collect the interest payments if they like, or within a specified period of time, usually 6 months, present proof of death, and the bank will refund all 100% of the original principal amount. So it's a good feature to have. But the beneficiary is really in the driver's seat in those circumstances, in that if they are due to receive an interest payment within the 6-month period, they can wait until that interest payment is paid and then exercise the death put and receive 100% of the principal back, or in the alternative, get it back whenever they like in that 6-month period. Patrick asks, is there an approved newspaper ad for the Goldman Sachs CD? Unfortunately, the answer, Patrick, is no. Banks don't like to do newspaper advertising. I have talked to a number of agents who've purchased from a third party the Entree marketing system. Those newspaper ads are advertising a report on how to get higher returns as opposed to a specific product, and that's working pretty well. I can help you with that if you want to give me a call here at the office. But no, there are no approved ads for the CDs. The banks just don't like to do that. Jimmy asks if the client canceled the policy before the 7 years, what happens? I think I've already addressed that. Gil asks, how often are values available during the year? Well, on most products, Gil, they publish a monthly update on the valuation of the CD. You can find that inside our agent portal on our website. We post those in there for every CD every month as we receive them, and you're welcome to peruse those, or if you need some assistance, your business consultant can guide you through that. But yeah, current valuations, approximate valuations are always available. Lynn asks, do they keep a list of bids on these if they are sold back to the bank, same way they used to do with limited partnerships when sold on the secondary market? Not that I'm aware of, Lynn. You know, that's kind of an interesting question. I mean, we have those that we've done historically here where we've redeemed CDs on behalf of some of you, but I don't know if the banks have that. Interesting question. I'll see what I can find. Jimmy asks, is interest paid yearly? Yeah, on all the products we have this month, interest is paid on an annual basis, so they'll get an annual payment coupon from the bank. The minimum deposit is $25,000. That is correct, Jimmy. Let's see what Lynn says here. Lynn, it looks like you've got a good question here that I don't quite understand. It says, does the Goldman Sachs program release the excess interest retained by the averaging formula in the last year upon maturity, provided it ends in a positive year? I need to walk you through that, Lynn. I think it's a little more complicated than I can explain here on the webinar. The reality is there is actually no excess interest because this is a variation of a point-to-point product. So what you're really capturing is the gain from year 1 to the 7th anniversary, but slicing it up into 7 individual payments. So there really is no excess interest left in there, but I'll be happy to walk you through that. Michael asks, can an investor split the $25,000 minimum into 2 or more products? The answer is absolutely yes. As long as the minimum account size is satisfied at $25,000, the CDs are actually purchased in $1,000 increments. So it could be divided up into 2 or 3 or even 4 different offerings as long as that minimum of $25,000 had been met. Jeff asks, is this webinar going to be available to view later? The answer is, as long as technology holds, yes. We do record these on a consistent basis. Occasionally, there's a technical glitch and the quality doesn't come out in a way that is satisfactory, but we do, as a matter of practice, record these on a weekly basis and then post them on our website behind the agent portal, and they're usually up there and running by Thursday, by tomorrow, the next day after the webinar. Ron asks, so you have any updated presentation kits available on the website? Working on those, but the answer directly is no, not at this point. Ron also asks, are there state-specific forms? The answer is no. There are only two applications, one for qualified money, one for non-qualified money. They are applications to open a self-directed custodial trust account with our custodian, Provident Trust, and they are not state-specific, nor do they need to be. Okay. Well, I appreciate all the questions. A lot of interest from you this month. Your business consultants know these products backwards and forwards and are just dying to help you any way they can. So if you've got questions, you'd like some positioning tips or just the finer points of these products, please don't hesitate to give your business consultant a call. That's what they're there for, and these are sharp people. So with that, I want to thank you for taking your valuable time today and joining us. I will look forward to chatting with you next week, same time, same place, Wednesday, 11:35 Pacific time. Until then, have a great week.